think this is the chief concern that they all have, that the interest rate environment we see right now is artificially low, maintained by the Federal Reserve, and being pushed lower by stimulus efforts, passed all around the world. And they all worry, and you can see their worry in the way they structure their stock and bond portfolios. They worry that rates have to go up at some point in the future. And they are already starting to protect themselves. One thing you can do as an insurer, you get rid of your bond portfolio, or you start really cutting back the duration or shortening it as much as you can, even to the point where you're holding a lot of cash. Even though you're not going to get any return on that cash, it's better than watching your bond portfolio erode in value as interest rates go up. And we've seen it with Berkshire Hathaway, we're seeing this with Markel. Both of them have really curtailed their purchases of treasury bonds. Markel, I think, is only holding about $300 million of treasuries right now on a multi-billion-dollar portfolio, within their bonds. And they've also brought the duration of their portfolio down to about 2.5. And that is, I think, the lowest Markel's ever been, since they've been a publicly traded company. They try to average somewhere in the 3 to 5, more to 4 to 5 range on duration to match their liabilities, to their assets, and to make sure the duration of their bonds pretty much matches the duration of the insurance liabilities and the payouts on the claims. But they're not doing that right now. They are worried about inflation bubbling up. They don't want to see erosion of the bond portfolio in terms of value. So they've got a portfolio that's more and more gravitating and looking like it's a cash portfolio. And I'm talking to Tom Gaynor yesterday about it, and he was talking to shareholders again this morning. This is not something, they understand they are in an unusual situation. It's unprecedented, like Warren Buffett said, to have interest rates push down this low and stay low this long. We're in uncharted territory. You got to protect yourself. And right now, if you're an opportunistic type of investor, you would rather hold cash earning nothing than try to put it to work to get 1% or 1.7 and take risks of principal erosion. Because that risk right now is much worse than the yield is. You are buying into, if you're buying 10-year treasuries, you're lending money to our government at 1.6%, and you can lose a lot more of that in terms of price depreciation if we start having inflation. So you get a negative real return on these bonds. I think they're all looking at it from that point of view. They would rather hold cash and sit on it for a year or two, knowing that when they do deploy it, they hope to get yields or returns much higher than 5%, maybe closer to 8 or 9%, and that's much better than holding cash or holding bonds that's going to pose some risks to them. So we're seeing these insurance companies, and not just Markel and Berkshire, but others, taking this move in their bond portfolios away from treasuries, more cash. They're holding corporate bonds, they're holding municipals just to get a little more relative yield. They're holding some foreign bonds, but generally they're slowing down their lending to government in general, and they are protecting against inflation, and they are assuming that inflation is going to bubble up at some point.